Ladies and gentlemen, it's time for the LPG panel. It's an honor to be here with such knowledgeable people, and it's also a pleasure to be on the panel with the Avance Gas President Christian Andersen and with John Lycouris from Dorian LPG. And this LPG will focus solely on the VLGC space, which represents 75% of all LPG and petchem shipping in terms of volume. For the past 2 years, we've seen rates going from $4 million a month down to less than $200,000 per month. I think the August earnings this year combined with the September earnings last year, which have been the poorest earnings we've seen in a very long time, has probably been the minimum floor for earnings and also the maximum pain for ship owners. And why the earnings have been so bad is the answer to that is it's not only one answer. You have the arbitrage between the U.S. exports and Asian imports. You have the supply of ships. Only in 2015 and 2016 you saw an order book of close to 50%. You had 22% more deliveries in 15 and the same figure roughly in 2016. So that's more than 80 ships that joined the VLGC fleet, which was quite the figure. You also had the opening of the Panama Canal, where VLGCs have transited 1/3 of the total Panama transits in the first year of operation. And that has also, of course, decreased the ton miles in the VLGC space. You had the OPEC cuts in November that came into effect in 2017 and decreased slightly the Middle East LPG exports. However, there is still comfort in the VLGC space. The order book has come down. The Asian LPG import demand is ever increasing across all the Asian countries and India. And going forward, the factors that will impact the VLGC rates will be the supply of ships, it will be the arbitrage. Rest assured the demand will be there. So today I would like to raise 3-4 topics, depending on the time we have. So talking about the supply of ships. Positively, we have seen a decreasing order book. Today I think it's at 28 vessels, so we're looking at an order book of 11%. And that is for deliveries during 2017, 2018, and 2019. There's one trader with an option for 6 to 8 more vessels that should be declared in the end of this year. You have the ballast water treatment coming into effect in 2019. You have the sulfur cap in 2020, and you have Tier 3 for new buildings. So my first questions to John and Christian is, what is your view on the current order book and legislative impacts in terms of new buildings, new orders, and the potential for demolition in today's industry?
Good morning, everyone. I'd like to start with a few comments about what you said in your introduction about the market. And yes, it has been a terrible market the past 2 years. The Baltic rate is a daily quoted dollar per ton price for freight from the Middle East to the Far East. And the Baltic this year turned at about $19 per ton. If we go back to 2009, the Baltic turned at less than $15 per ton. And in 2009, we also had much higher fuel costs. So even though that the market has been terrible this year and last year, it's not as bad as we saw it last downturn. And in the middle, we have had a super profit, which has never been seen before. LPG, as I normally say, is very special from any other product and any other commodity, because no one has ever produced LPG because they want LPG. LPG is a byproduct of crude oil and nat gas. And what is very important to understand is when you look at the LPG sector and the VLGC sector, you need to have a view on crude oil and nat gas production. And as we heard in the previous panel, everyone is positive and optimistic about natural gas and LNG production. And when we look at the forecasts for crude oil, it's looking very good. The Middle East had a short drop with the OPEC cuts, but the LPG production in the Middle East and LPG export from the Middle East is in line with the 3 years average as we speak. So everything is about US and shale gas and shale oil and tight oil production. And the forecasts for the US production is very good. The rigs are much more efficient today than they were a couple of years ago. The break-even, crude break-even, wellhead break-even in the US is down in the 30s and some fields even below 30. So we are optimistic about US production. Going back to your question about the order book, yes, the order book has killed the super profit market we saw in 14 and 15. There's far too many ships ordered. When we finish this year, and actually when we finish this month, most of the ships are delivered, and the order book going forward will be about 10-11%. That's positive for shipping, of course. While it takes 2.5 to 3 years to build an LNG carrier, VLGC might be built in 1.5 to 2 years. Basically, you can say 2 years. So we know very well the deliveries next year, and we know pretty well first half 19. That's looking positive.
Thank you, Christian. John, anything you want to add to that?
Well, I couldn't agree more with what Christian said about the market and about LPG becoming a mainstream export because from the advent of shale gas and as a byproduct, as he said, of LNG and crude oil, we are seeing substantial quantities of LPG moving out of the United States in addition to the Middle East. And that has changed the balance of this particular fuel becoming a mainstream energy source. Also, we have to remember that LPG, butane and propane burns cleanly, and it will be probably the fuel of the future, along with LNG, where the grid cannot reach. We will still have LPG being a preferred energy source. In as much as the fleet is concerned, yes, many ships have been built. We are just right at the tail end of that building spree. The legislation coming into effect in 2020 and the soft markets will probably deter more ordering because the legislation with the sulfur cap, the Tier 3, causes not a very clear view forward. And as a result, we believe that there's not going to be a lot more new buildings coming online. Even though there is capacity, there is unlikely with soft markets to see further ordering. So that's all I had to say.
That's actually there I found something where we disagree, and that's a bit difficult. I fear that we will see more orders. I think the new building prices, as they discussed in LNG, is at the rock bottom. And today you can order VLGCs at prices seen back in 2000 and 2001. So unfortunately, there will be new orders. I don't really expect to see a lot of scrappings. There are a number of ships, and you can easily count 10, 15, maybe 20 plus as well, ships which are potential scrap candidates. and they will be expensive to run with high fuel consumption. What we do see in LPG, though, is that these ships very often end up in storage projects. So these will disappear from the spot market, but they will sit around as terminals, which I think in a way is positive because more terminals will support more trade.
Thank you, Kristin. You both mentioned the positive aspects around the LPG market as a whole and U.S. exports. And from 2014 to 2016, we saw U.S. exports increasing from around 15 million tons per year to 25 million tons per year last year. And the projections from the start of this year for 2017 was less than 30 million tons. And now it seems to be to break the 30 million mark, which is very, very positive. However, there is constraints concerning domestic consumption and concerning terminal capacity. I think there will always be enough LPG, from what Kristin said, from all the shale plays and total U.S. production. But in terms of terminal capacity, do you guys expect more expansions to come to support the increasing U.S. exports?
I have seen that a lot of terminals have nameplate capacity which is in excess of what they are been exporting. I think the capacity is about 35 to 40 million right now, and it's being expanded continuously. We're going to be seeing more terminal expansions in the northwest of the United States. In Philadelphia, Marcus Hook is going to be exporting larger amounts of LPG. And we are seeing the ramping of Phillips 66 terminal at Freeport, Texas. So we have seen a number of projects that increase capacity, and I think we're going to see excess of 40 million tons capacity in the United States.
That should suffice for some years.
I think so.
I absolutely agree with you, John. It's terminal capacity in the U.S. Will not be a bottleneck as it was a couple of years back. We will only, if nothing is done from today, we will reach capacity levels at 1920. But as you say, there is a number of expansion projects. The easiest way to increase the capacity is actually to increase the load rate of the ships, which you can do fairly easy and at not any significant cost, adding pumping capacity. If you want to expand more, you can widen or install wider pipes. So you can increase the capacity fairly easy. And as I said, terminal capacity will not be a bottleneck for U.S. LPG exports.
A good test of this capacity will be in the next weeks. We have seen 600,000 tons of LPG held back because of Hurricane Harvey. That meant a lot of ships have been waiting, and these exports have not happened yet. So we will see whether they will be able to catch up with exports in the next month and reach their kind of level where they were expected to be at this time of the year.
Thank you, John. As I mentioned initially, talking about the Panama Canal that had its first year of trade, and then I'm talking about the new locks, of course. And with the first year of operations for all the ships that went through, the average transits per day was around 4 to 5 transits per day, where the full capacity of the new locks are at around 10 to 12 per day at max. So my next question is more on a ton-mile reflection, because there are many more containers, cruise liners, and also the LNG exports out from the U.S. that only started last year will increase more and more. And in terms of a fully spot-operated company and a semi-spot company for Dorian, how do you view the potential congestion say, from 1.5 to 2 years going forward, because the new LOX, a $5 billion investment, is not something where you will expand again in the short term. In your view, will this affect the trade patterns for your spot vessels?
I think that you have to take a step to the side and look at what is the drivers of the export. And I think you mentioned the FOB-CIF differentials between US and Far East, what some people call the ARB. And theoretically, through half the year, LPG prices are in contango, and half the year they are in backwardation. So normally, during the winter, LPG will have a premium price compared to crude, and everyone expects this to get off during second quarter, and then sometime during third, fourth quarter will come back again. So when the product market is in contango, our customers want the ship to sail as long as possible, and if possible also to sit close to discharge area and run the contango price game. So decision about Panama and not Panama is more about the prices in the product market than what is really available. Having said that, Panama has been surprisingly full, and it's been almost impossible to book spot slots in Panama for LPGs. So we have seen less ships using Panama than expected. So again, it's driven by the product market and less by the Panama availability, in my view.
To add to Christian's points, just some statistics I would like to say is the new Panama Canal has managed to have 2,000 ships go through up to date in the about 18 months it has been operational, 16 months. And out of these, it was a surprising number that 29% of LPG ships went through in the year to date, as against 9% for LNG carriers. And now we're seeing a reversal where LNG is going to be will take priority probably over LPG, and we see bookings of about 20% for LNG against 16% for LPG ships. The bookings, as Christian mentioned, are very difficult. They are booked all the way into 2018, and usually about 70% of the ships that apply for crossing for a transit get through, because the rest cannot get slots to go through. So Panama has started to create a backlog. The waiting time right now is 3-4 days to get through, if you get lucky with an empty slot. There's a waiting system, there's a number of systems that Panama Canal Authority uses, depending on your use of the Panama Canal, et cetera, et cetera. I'm not going to bore you with that. However, I believe that Panama Canal is also going to become more expensive in October, 29% increase in tolls. That's going to cause a lot of change in the way we see the ARB, because, as Christian said, it's a matter of the arbitration between the prices in the U.S. Gulf and the price over in the Far East. Many times the trade does not happen because there's no positive carry on this. As a result, I think that more ships may decide to go the long route, the 40-plus day via the Cape, instead of going via the Panama Canal. And the economics probably work better for nowadays, and also helps shipping in a situation where there are soft markets and there's excess shipping available.
Thank you, John. Thank you, Christian. We've mentioned the arbitrage. That seems to be the most repeated word in VLGC. And if you look at the correlation between the Baltic index that Christian mentioned, and you compare that with the arbitrage, there is actually a strong correlation. So my next question is, it's a bit theoretical maybe, but it has to do with what affects the shipping rates, the freight rates more. Is it the supply of new ships? Because you talk about a huge order book, but if you still have a fairly big substantial arbitrage, price differential between the LPG in the US and Asia, that should support shipping rates. So what of the two, the supply of ships or the arbitrage, in your view, affects the rates?
This is very complicated, and I'm sorry to say, Martin, but it's not either or. In the daily shipping market, when we fix a ship, we don't really care if our customer makes money or if he loses money. For us, it's supply and demand of ships for that particular cargo, and so this is a fight between the two of us and a couple of others every day for every cargo. And if there is enough ships, the freight will go down. If there are less ships, the freight will go up. We don't look at the ARB, we don't look at the crude oil, no, nothing. Looking at the expected demand for ships going forward, we do expect that the freight market is continuing to be very, very difficult well into 2018. There is still 10 ships coming this year from the yards. So there will be hard competition for cargoes going forward. We do hope that when we come into mid-second half, second quarter next year, that the market will turn. Order book for next year is limited, and the expected export of LPG from the US is growing month by month. It will fluctuate a lot because of the ARB, and that will give us challenging freight rates for the next 6 to 8 months.
Just to add to this, the recent Hurricane Harvey has caused a shortage of cargoes going to the Far East. As a result, prices in the Far East have gone very high, opened up the ARB instantly. Immediately, prices also in the US Gulf have gone up, and also freight rates have gone up as a result of this. It's probably temporary. However, it just shows you how exogenous factors can affect this business. Also, for example, the price of oil, the price of naphtha vis-a-vis LPG. The price of LPG in the United States is very high as a result of low inventories and low production. That has caused concern in the United States, therefore has pushed prices higher for LPG. As a result, that decreased the ARB recently before Hurricane Harvey. So it's a mixture of factors that play all the time, and things change very quickly from positive ARB to negative ARB. Yeah. So it's just where the trader has booked his cargo, and as Christian says, the ship is the ship. He has a means to transport it from A to B, but he needs to book his cargo and his delivery.
Thank you very much. So I think we can agree on that. It's a healthy order book. Hopefully, there will not be too many orders in the short term. 2018 should be the turning point in terms of rates, and if you look midterm and going forward, it should be very positive. Also with the increasing U.S. exports that have the necessary capacity. And I think I saved us maybe some time. I have no other questions. I don't know if there's anything Christian or John would like to mention as a last final note to the audience.
My advice is always, if you want to follow this market, it's really about the U.S. export. So if you want to find one key figure you want to follow, look at U.S. export, 66% of the U.S. export year to date has gone to the Far East. So it's huge amounts of LPG, and we are, to a certain extent, less dependent of the ARB now than we were last year, because that we see some of the lifters of US LPG have included value, which is the FOB price in Houston, in their invoice to their customers in Far East. So these people will invoice the same price as they pay for their cargo. This is positive for trade, and we do hope that this is a trend which will continue and grow even more. Number of cargoes in the US, if you look at VLGC's cargoes per month, US Gulf and Marcus Hook can do between 55 and 60 cargoes per month. In June this year, they did 32. In July, they did 38. And before Hurricane Harvey, the expectations were 40 to 44 for August. So we think that the number of cargoes will pick up second half this year, as it did last year as well.
Thank you, Christian. John?
One more point about the LPG production and consumption and exports in the United States. One has to look also at the consumption in the United States for LPG. It is very important and a very sensitive guideline of how the market is going to move. We had instances where there was a very big draw from the United States due to weather or due to crop drying or due to many other reasons, and that affects LPG exports and also the pricing of LPG. Once we see that there is substantial inventories, then we can be assured that this is going to translate into exports from the United States. So,
thank you very much, gentlemen.
yeah.
Thanks.